Hey, Mike Shea again, Florida business broker with Transworld. I'm going to talk to you about a little bit more of the alphabet that business owners will encounter as they go through the business sales process. So let's talk about DE, SDE, OB, and EBITDA. What are they, and why are we using alphabet and acronyms? Never mind. When we do valuations of businesses, we are looking for what a business produces in free cash flow to an owner. So assuming there's no debt. So what I always ask an owner is, what do you make? Now, when an owner does that, they think about what they put in their pocket. And that will include, if they're financing a truck, they're taking that number after. So generally speaking, when I'm just talking rough numbers over the phone or over a Zoom call, before I've ever looked at a financial, they're spitting out a number, and 99% of the time, the seller is soft. We, as brokers and valuators, will go in and adjust back expenses that will not be transferred because debts aren't transferred. Think of it like a house. You buy a house, the mortgage that the seller has gets cleared at the closing. Same damn thing happens in a business sale. Depreciation schedules get reset. Amortization schedules get reset. If you want to ask me about what that is, call me offline. But your balance sheet 99% of the time does not transfer to the owner unless there's a stock sale, or to the buyer buying the business unless there's a stock sale. And that's very, very rare, and generally only in specific cases when there's like licensings that have to be transferred or formulas that have to be transferred, or in larger private equity type transactions. But in general terms, we don't transfer debt. So we adjust back the expenses that will not be the buyers as they go forward. So for example, I'm driving a Mercedes, I pay $800 a month. The buyer buys my lawn business and the Mercedes is sitting in my lawn business. The buyer's not buying the car. He doesn't need it, doesn't want it. It's unnecessary, but we're expensing it as the seller through the business for tax benefits. We're going to adjust back that expense to the bottom line because it's discretionary. It's cash flow to the owner. So that, in short, is what owner benefit discretionary earnings is. You'll hear it called both things. Or one more, cash flow. So when a broker's talking to you or an educated buyer's talking to you, they ask you for your discretionary earnings number. That's what we're talking about. Now here's the formula. An owner's salary and their payroll taxes, interest, depreciation, amortization, net profit, and any one-time or personal expenses. That's a questionable run. One-time or personal, what does that mean? Here's an analogy for you. Say there was a hurricane that put a park bench through the front window of your store, and you had to repair that. And instead of reporting it to your insurance company, you paid for it out of pocket and it's on the financial statement. We would adjust that expense because it's not normal. We adjust it back as free cash flow. So that right there is what you will hear brokers call discretionary earnings, or seller's discretionary earnings, or interest, or or seller's discretionary earnings, or owner benefit, or cash flow. That is not EBITDA. EBITDA, and you'll see this on Shark Tank when Cuban will ask a business owner, hey, what are you making? And the business owner will spit out a number. Then Cuban will go, does that include your salary or does it not? EBITDA is the cash flow with a salary still in there for the manager or the owner. So we're looking at a passive investment from an EBITDA standpoint. Why is that important? That's important because different types of buyers use EBITDA and different types of buyers use owner benefit. The savvy broker pits the buyer who looks at EBITDA against the buyer who looks for owner benefit and tries to hold the price line, because you may get a higher multiple on EBITDA, but it's probably less net money to you because your salary's still in there. And sometimes, particularly in larger deals, your salary is pretty large. So don't get twisted when you hear multiples bandied about. So when you're talking to your friend at the bar and he says he sold his $4 million landscaping company, for $4 million, and he said he got a 6 multiple, he probably didn't get a 6 multiple on owner benefit. He probably got a 4. When you're talking to a broker, the broker will spit out a multiple based upon owner benefit 99.9% of the time. You, as your shopping brokers, need to make sure you're using the right terminology for the baseline multiplier so that we don't get things confused and you make a valuation and pricing decision on the wrong metric. So that is EBITDA, owner benefits, seller's discretionary earnings, all rolled into one in a short 5-minute video. If you have any questions on a personal level, call me at 321-287-0349. You can always email me at mike@tworld.com. Have a good one.